Barry and I got to spend a little time earlier in the week, and there's a number of different ways this conversation can go. After talking to him, I step back and I go, it's almost like Frank Sinatra. Give him the mic and let him go, because he's got so much valuable information. What I would suggest different than ever before is grab a paper and grab a pen, because you're going to want to take notes. There's some needle moving moments that Barry's going to share with you. And just in the respective time and all of your busy schedules, we tried to narrow down a whole bunch of really good points into about 3. And those 3 was the real estate market as a whole, what's going on with interest rates today and tomorrow, and where do we see opportunities in the space. And so with that, let me introduce our guest, CEO of MBS Highway, Barry Habib.
Well, boy, Bill, that's so kind of you, and thanks to everybody for being here. I know that first of all, your time is certainly got a lot of demands on it, so we'll try and make it as valuable as possible. And you know, I think Gina mentioned this earlier, and thank you for the kind words, Bill, and thank you for the kind words, Gina. You had said that we want this to be really interactive, so there's a chat window there. If you hover your mouse over the Zoom platform, there's a chat window there. I've got mine open, so if you guys have questions, you know, where we want to talk about is maybe, you know, what does the market look like in general? Let's focus on real estate. You might have some questions on that, and people talking about, is the real estate market overextended right now? How long will it remain hot? How will COVID affect the real estate market? How will unemployment, if it remains at higher levels, what will that do to the real estate market? And also you might want to know perhaps geographically what the real estate market might look like. Now, my expertise is more on the residential side, not really able to give more than just some overview on the commercial side, but I think we all know that the commercial side is challenged quite a bit. But on the residential side, any questions that you might have there, whether it be geographic or whether it might be overview or specific, please pop them in the chat window, and we'll try and do that. So I'm going to share my screen. I'm going to kind of just go with you on where we are here. So listen, I think that the time is definitely now for real estate. I've been pretty optimistic and bullish on real estate market. We, as both Gene and Bill were kind enough to say, we made some very good forecasts on where the real estate market could be going, and we've been kind of counter to both on interest rates and on the real estate market to where the consensus has been. That's because we look at several factors, and some of them I'll share with you as we go into this. So, you know, demographics plays a big role, and it seems that right now people are waiting longer to get married. The average time that somebody gets married today is pretty close to 30 years old. It's very different than what it used to be. You know, it wasn't that long ago that people were getting married at 20. I mean, you know, maybe it is that long ago. I guess I just look at it from my perspective, but it's changed quite a bit. So people are waiting longer to get married. If you wait longer to get married, that means that oftentimes you wait a little bit longer to have children, and that is an important driver of the real estate market. If you take a look at people that are millennials, 30-somethings, okay, so someone between 30 and 39 years old, if they don't have any children, their home ownership rate is 38%. However, just having one child, so you don't need a minivan with 6 kids hanging out the back of it, just one child, the home ownership rate changes to 80%. Okay, so this is a very important aspect when you're trying to forecast where the market's going. So one of the great tools that we can always look at, you guys have access to it, the beautiful thing about it, it's free, is it's Google Trends. So you can put in different search terms in Google Trends, you can see what's trending. And if one of the things that you wanted to find out was about, are people going to have kids, a term that you might want to take a look at is baby registry. And in the history, which isn't admittedly that long, about 16 years of Google Trends, lockdown caused some people to get busy? I don't know. You know, one way or another, it's going to cause some household formations. Either people said, hey, man, I'm locked up with you for a period of time and I discovered I really don't like you, or we're going to occupy some time here and now we are going to have a baby, and that is going to cause a lot of home purchases. And when you take a look at where people are purchasing, what are the hot markets? Well, it's a trend that's really been exacerbated by COVID, but I want you to know that this trend was happening already. And that is that people were moving out of urban and into the exurbs. Now, exurbs, if you're not familiar with the term, Exurbs means the ring that is beyond suburbs. So if you think that the core is urban in metropolitan areas, the first outer ring of that is the suburbs. But then the next ring is the exurb before you get to rural. And this is what is the hottest segment of the market. And when you take a look at what's driving the growth now, well, it's kind of surprising. It's people under 35 years old, and even more so people under 30, and quite a bit of growth that we've seen like never before, people under 25. So what's happening here is that people are getting out of rentals, out of tight quarters. People want simply more space and more distance. Those are two different things. More space means interior space. Heck, I've been quarantined, I've been locked up, and I need more room, or I can work at home and I want to have that extra bedroom for that potential office. And that's going to affect the dynamics of real estate, because where two bedrooms were at one point in time sufficient and good, even if people don't need the third bedroom for actual sleeping, they're discovering that they need that for an office, for a home office of some sort. So you will see the two-bedroom market lag behind anything that is less than a three-bedroom market, even if individuals don't need that third bedroom just yet. So I think that that's an important factor. When you take a look at the growth rates, as I mentioned, it is all coming from the youth, which tells us that, you know, this is an important segment to market to. And if you take a look at how frequently those people move, you take a 12-year period and you take a look at people that are under the age of 35, they're going to move 4 times rather, in a 12-year span, as opposed to somebody who's over 50. Now, you don't want to ignore that segment, but if they're over 50, they're going to move 1 time over a 12-year period on average, as opposed to someone who's under 35, which will be much more highly mobile within a 12-year span. So it means we got to market to these people. And that means that when you take a look at your marketing plans, you can't exclude Instagram. And I think so many people do. I can't tell you the amount of individuals that think they've got it dialed in on social media, and they say, yeah, I got a big presence on Facebook. And look, Facebook is great. You definitely need that. That's probably the predominant tool that people use. However, ask anybody under 35 if they spend a lot of time on Facebook versus Instagram, and they will tell you that, you know, they oftentimes don't even check Facebook. It's Instagram is where they go. And it's important for us to make sure that if we are intending to do any types of marketing, that we do make sure that we nail it on Instagram. Now, look at these faces. None of them, like me, need reading glasses, right? So this is an important aspect for what we see trending in the real estate market from a marketing perspective. Now, where does real estate look like it's going from here? So, you know, we made some pretty good calls, some really good calls in the real estate market. And we did forecast the exact bottom. I made that forecast on CNBC. Everybody argued with me. And that was in December of 2011. We called the turning point on CNBC. They said that's not going to happen until 2015. Got a lot of naysayers, a lot of arguments. But in fact, we were just about exactly right. And one of the big aspects that we looked at was demographics. I don't know if you've seen the movie Ford versus Ferrari. That was a really good movie. But the character of Lee Iacocca was an important one there. And Lee Iacocca really focused on demographics. And Henry Ford II kind of poo-pooed it, said it was mumbo jumbo. And they would fight about this all the time. But Lee Iacocca was right. And it was why they created the Mustang. Because when in 1965, well, you think about that, right? 55 years ago, and we still have that brand. There's not many brands that endured 55 years. But in the movie, he even says this, he wanted to create something fast, fun, and affordable. And the reason why is because he looked at the demographic chart. And this chart here is one of birth rates. So you could see people in each generation, and this is the year that they were born. And you could see the baby boomers and the Gen Xers, the millennials. And when you take a look at baby boomers here, and this is exactly what Lee Iacocca was looking at, he looked at this enormous spike in births here and then determined that 18, 19, and 20-year-olds in 1965 needed a car that was fun, fast, affordable. And that's where, although he had to fight Henry Ford II for it, created the Mustang, and it was the most profitable car in the history of the auto industry. So when we look at this today, let's get some facts. So according to Zillow, the median age of a first-time home buyer is 33 years old, which means they were born between 1986 and 1987, and that's right here. So as we look at this chart, what I want us to take a look at is look at what has happened since 86, 87, and we could see birth rates went up rather dramatically. which means that you're going to have more and more and more first-time home buyers that are going to come into the marketplace. So if you think inventory is tight right now, you haven't seen anything yet. Now, the other aspect of this is that while they'll go up for the next 4 years and then actually come down a little bit, remember, they never get below where current birth rates were that are representative of those first-time home buyers today. So we're always, at least into the foreseeable future, going to see higher demand than we are experiencing today on the engine of homeownership, which is that first-time home buyer. Now, you know what's really interesting is to look at how accurate this is. And one of the reasons why we did get a lot of credit for calling the housing bubble when we called it, and we simply referred back to this, you know, so no real secrets here. It's not as if we were really smart. We just tried to pay attention. And what you'll see here is that in 2006, when we said there was a housing bubble coming, what occurred was we looked at the birth rates from 33 years before that, which was 1973. So 2006, you go back 33 years to 1973, and that's right here. And there was an enormous drop in the rate of births in 1973. And I don't know if anybody wants to take a guess as to why. If you want to put it in the chat window, kind of fun if you wanted to guess why did birth rates drop so dramatically in 1973? Now, by the way, some people might say birth control, but no, that's this. Birth control was released in 1960, and this is what birth control did, okay? That ended the baby boom. And when you take a look at this big drop in 1973, anybody want to put in the chat window and give it a guess? Let's go to chat and pop it in there. Let's see, there's no bad answers. I'm curious to see what you think. All right, well, the answer is abortions became legal. In January 1973, the Supreme Court ruled Roe v. Wade, abortion's legal, and you have this precipitous drop in birth rates, which remained low for a while. And that's what made the housing bubble. Now, yes, there are other contributing factors. In an effort to make up for the lack of demand, programs got relaxed and it exacerbated the issue and made it much deeper. But at its core, the reason for the housing bubble was due to the fact that 33 years prior, the rates of births dropped precipitously, meaning less demand. And if you take a look at the next chart, it kind of spells it out. Now here, the blue bars represent households being formed. So what's that? Somebody puts the lights on for the first time. You know, it's somebody leaves mommy and daddy and they get themselves a place of their own. And if you take a look at this chart, it's kind of a hand in glove of where this chart is. You see, you take a look at the big drop, levels off, starts to move up, right? Well, once again, hand in glove, the blue line, big drop, levels off, starts to move up. It has to be that way because this is what happened. Those people were born. Now, remember that when we looked into the future, here's where we were 33 years ago. So before we look into the future, what did we know? We know that in the future, that blue bar is going to continue higher, right? That blue bar is going to go up, up, up over the next few years. Now, the gold bars, that's the correspondent amount of homes being completed by builders. And you can see in 2002, 3, 4, 5, it was somewhat close, no big deal, but the big disparity came in 2006, 33 years after abortions were made illegal. So therefore, were made legal, forgive me. So when you had the lower birth rates that occurred, lower household formations, but builders didn't pay attention to that. Builders never bothered to look at what the demographics or birth rates were, so they blew it. And you had an imbalance in inventory. You had far more inventory than demand. That causes prices to drop dramatically. Now, you want to know why the housing market is hot? It's no secret. It's because you got simply more demand than there is supply. Builders cannot keep up. And we know this line is going higher. And unless builders really, really ramp up production, you're going to be in an environment that's going to be very supportive of housing for a long time. Now, of course, the caveat here is that different environments will be, different markets, different zip codes will behave differently. But overall, there's simply more demand than there is supply. And, again, this is another look at that chart, and into the future, we know where we're going here. Now, when we look at that supply coming to the market, it had been lagging, as you saw in the previous chart. But when you look at new construction, housing starts, look what COVID did. COVID caused a big hole that has to be made up. So we already had an imbalance. We already had a lack of supply. and COVID just made it worse. So builders are going to really try and catch up. So when we look at how builders are doing today, they're doing well. They have some price power, and they also see units flying off the shelves for the most part. Why? Simply lack of demand, lack of supply, and too much demand. And when you take a look at overall inventory, it's kind of foolish when people talk about the housing bubble aspect. You know, I listen to some people, and you know, sometimes the media, you have to take it with a grain of salt, because really what they want to do is they want to try and stir up some controversy. They want to, fear gets ratings. So the media is always going to go from a point of view of fear. And when you hear people talk, oh, is the housing market overheated? Is there more, is another housing bubble coming? Well, duh, this is a housing bubble, okay? This is a housing bubble. Too much inventory. This is a housing bubble. In the 80s, we're at the lowest level of inventory on record. Now, record is defined by the last 40 years. That's how long we've been keeping it. But we are at the lowest point we have ever been since they've been keeping records for the past 40 years. In order for there to be a housing bubble, you have to have more up supply than there is demand. We're in the exact opposite situation right now. And not only that, but vacancies. I mean, think about this. You have more of an impetus to dump the home if you're carrying the home that you're living in, and you also are carrying an old home that you're not renting, you're trying to sell it, you're not living there anymore, so it's just hanging over your head, and you justify dropping the price. Why? Because, hey, I'm paying $3,000 a month on that mortgage, or $2,000 a month on that mortgage. If I sit with it for another 6 months, that's $12,000 or $18,000. Let me dump it and sell it for $15,000 or $20,000 less, just to dump it. Well, yeah, when inventory's high, you can have that opinion, but inventory's at record low levels as well when there's vacancy. So these are things that people don't think about when they blurt out, oh, is there going to be another bubble? Now, I talked about the fact that we did make some really bold predictions. You could look this up all over. And I did forecast that the 10-year Treasury was going to go to 1% when it was close to 3%, and everybody thinking it was going to go to 4%. And people thought I was smoking something. But here's what we have to understand, is that people have a misconception of debt. So what we're doing here in the United States is we're accumulating debt at a very rapid pace. And I'm not saying that we shouldn't do it or whatever. There are humanitarian aspects. I get it. So forgetting why we have the debt, let's just go with the fact that we have the debt and it's going to increase. Debt is a drag. What is debt? Debt takes a future purchase and brings it forward. So it drags what you're able to do in the future. Let me just come off this just for a second so I could talk to you about this, because this is an important concept that I want to make sure that we're all on the same page with. So what we know is everywhere in history and everywhere in the world, China, Europe, you want to go to Japan, anywhere you want to go, history, the UK, the US, the higher the level of debt, the greater the drag, lower, not higher, on interest rates. People confuse what we're doing. They say we're printing money. We're not printing money. There's a debt instrument. Printing money is the Weimar Republic or Hungary or Argentina or Zimbabwe. Those that were printing money, that was like a credit card that had no payments. The debt that we're having has an associated payment, and that's why that debt creates a drag on economic activity. It's called velocity of money. The velocity of money in the United States is extraordinarily low right now. It's at 1.3%. It's one of the lowest levels we've seen. So what is velocity of money? It's a term you've probably heard. Let me try and explain it in simple terms. If you go out and you borrow money from the bank to buy a car, so you take out a $40,000 car loan, and it's got a corresponding monthly payment of $800 a month. So when you initially make that purchase and you create that activity, yes, that has some velocity of money, because the person who sold the car, the manufacturer, they're able to pay people, and they can go out and they could buy food, they could buy furniture, they could buy clothing, things of that nature. So it creates an initial surge of activity, but then that debt service of $800 a month drags on economic activity, because now I have $800 a month less I can spend. But think about it like this. If that purchaser of the car went out and now started to drive for Uber, and they made $3,200 a month, well, then their velocity of money is 4 times the cost. Okay, so we're just not seeing that. In the US, our average velocity of money is 2.2. It is down between 1.3 and 1.4. I'm telling you all this because what all this means is that interest rates have a lot of downward pressure. And if you think that the 10-year Treasury today will see that auction, it's about to take place in 30 minutes, I believe it'll have some good appetite at 67, 68 basis points, as ridiculously cheap as that sounds. But compared to the rest of the world, we're in very good shape. And where people are buying bonds today is capital appreciation. Nobody cares about the yield. You care that if you buy a 10-year bond and yields drop 0.5%, you're going to get 0.5% 10 times. So it's like a 5% return on your money. Okay, that's what people are looking at. And that's why I think there'll be good demand. And that's why I also think that you're going to see that 10-year Treasury eventually get back down to 30 basis points. Now, let's go back to what I was showing you here. And when we take a look, not only do we make some calls like that, but then when I called it the 10-year Treasury would go to 1, everybody thought I was nuts. And then when it did, everybody brought me back on CNBC and Fox. Said, okay, Barry, okay, it went to 1%, it broke, and you could see it was 93 basis points. And then they said, okay, where do you see it going? And I said, well, based on where we are, it's got to go to 0.5%. And they said, well, I want to debate you on it, this and that, and sure enough, we dropped to 0.5%. In fact, it dropped to 0.31 at one point in time, but I see us going back there. So I think there's a lot of capital appreciation to be made in the bond market. And I think that yields will have a tough time rising. Listen, things don't happen in a straight line, but inflation, as witnessed by today in the CPI report, while still very low, has increased a little bit. And we will have some portions within our economy where you'll have a demand spike. I'd like to see if there's any questions there. And meanwhile, I have a great book coming out, which kind of explains a lot of the stuff that we've talked about in detail. And it's called Money in the Streets. It's coming out October 27th. You can pre-order it on Amazon. But are there any questions from all of you that you'd like to go through? Or Bill, are there things that you'd like to go deeper on that we can kind of have a little bit more of a discussion? I want to take the first portion of our time to kind of talk about some topics. Do you want to talk about the stock market, the bond market, interest rates, real estate, anything you'd like to talk about, how the unemployment rate might impact us, anything you'd like that's on your mind?
Yeah, one thing I'd add, Barry, as your chat fills in, most of you know our parent company is Wedgwood. Wedgwood is the largest acquirer, fixer-upper, and seller of assets in the United States. They purchase, fix up, and flip about 4,000 properties a year. Why I bring that up is they have incredible market reference that supports what Barry's position is on real estate appreciation. We're seeing, like right now, in the belly of the beast of this pandemic, their properties are coming, and these are really first time and then step up properties. They're trading at 102 to 104% of list, no concessions, few contingencies, and faster escrows than they've ever seen in the 40 years they've been in the business. And this is in the middle of this pandemic. And so Barry uses charts. I support those charts with trades that are happening at 350 to 400 a month. That's throughout the United States where they're located. And I think, our feeling as it relates to rates and why it probably is apropos to this conversation is that is the takeout for what we do, right? If we're private money, we're the step before. And to know that that end buyer of that asset has the ability to transact in a 2 to 3% 30-year fixed rate, and you know this, Barry, I don't have to put these words into your mouth. It's unbelievable. Like I look back over my shoulders and say, people are getting 30-year fixed rates under 3%. Like what buying power that opens the doors for so many individuals who maybe didn't even think buying was an option. So
yeah, all good points, Bill. And the fact of the matter is that, while they won't stay low forever, there is a lot of pressure lower on rates. They may not get the lowest rates because lenders have a position of, limited capacity now with things the way they are. So therefore, they may have the opportunity to pass on lower rates, but they just can't do so because they can't take on more transactions they're doing. And remember, the mortgage industry is doing this with essentially people working from home too, which I would argue is less efficient, but they've done it and made the transition pretty much seamlessly and don't get enough credit for it. Now, there's a lot of questions coming in. So the first one is, how will the unemployment numbers impact the housing market in the next 3 to 6 months? So let me start with this statement here. The unemployment numbers you're getting from the Bureau of Labor Statistics or BLS are bullshit. Okay, that 10.2%, forget that. Okay, there is no chance that it's 10.2%. So first of all, the Bureau of Labor Statistics themselves, they admit that there's a misclassification. So they've misclassified workers to the tune of what they claim is 1%. So the BLS admits that it should be 11.1%. But there are two aspects of this which are very important that we have to understand. And the first one is that one of the things that excludes people from the labor force, so the labor force is about 160 million people, but 7.7 million people were excluded from the labor force. Why? Because those individuals say they did not look for work in the past 4 weeks. So they're removed from the labor force. Like, hey, I don't need, like they're going to independently retire wealthy now suddenly, right? So I guess they figured 7.7 billion people hit the lottery, right? So let me tell you why. People are not looking for work in the past 4 weeks for a few reasons. One, they can be incented because they're making more staying unemployed because of pandemic unemployment assistance, which 16 million people are receiving. And that's that extra money, which is an incentive to not to go to work. Second, there can be some legitimate concern that I don't want to put myself at risk for COVID. The third thing is that if you were employed at a gym, why should I look for work if no gyms are open? If I worked in a restaurant, why should I do it if no places are, if I worked in a movie theater? If you were like me and you had shows on Broadway, if you had shows in Vegas, an actor or somebody who worked in my theater, they're not going to look for work. Every place is closed. So it's a mandatory shutdown. But yet the Bureau of Labor Statistics, in their infinite wisdom, says, let's remove them from the labor force. So if you were to reapply those people into the labor force, if you were to re-put them into the labor force and count them as what they should be, is in the labor force, but unemployed, it would drive the unemployment rate to 15%. So BLS says 10, we admit it's 11, you add them, now it's 15, and then there's another layer. There's two surveys that give us the unemployment numbers. One is called the household survey. That's where you get the unemployment rate from. And what they do is they actually call individual households and they do visitations. And the response rate is much greater. But due to COVID, they're not doing visitations anymore. So the response rates dropped significantly, which causes a lot more variance and less reliability in the numbers. And here's the other aspect, is that businesses, and there's quite a few, this could affect approximately 6 million workers and affect the unemployment rate like another 3%. Businesses who were now in a position where they did not respond, well, that lack of response was interpreted, they were instructed by the BLS that their surveyors take that and they apply the average to that instead of, they didn't respond because they were just closed. So if you apply that, our unemployment rate is closer to 18%. So sorry for the long explanation, but let's understand what our real unemployment rate is. Now, why has housing been somewhat immune to it? Because you have people that are really getting out of rentals and want that space, as we talked about earlier. And secondarily, the people who are home buyers have been more resilient. Plus, you have more people that are coming in due to, as Bill said earlier, the lower interest rate environment, which is bringing people in. So for right now, low interest rates is trumping or beating the COVID situation. Now, COVID is really taking its toll on renters and landlords. That's definitely a major, major issue. But from the home purchase arena, with the lack of inventory, with a low interest rate environment, and with the ability to people who are in a position that can be homeowners to more often than not have the ability to still be able to work somehow because they have work at home capability, the housing market has been resilient and immune to that. Now, it says, where in the US do you see the most demand for investments? There's certain markets throughout the country that are performing very, very well right now. The Northeast is doing very, very well. California, in spite of the tax situation, is super hot. That's just, California's home ownership rates are low. They're in many, many locations below 50%. However, California has so much population that they can live with a 49% home ownership rate, which is different than the US home ownership rate, which is closer to 65%. That's another number. Don't believe when they say 68. They got that wrong in the surveying. It's closer to 65. But California has so many people that even with a 50% or 49% home ownership rate, there's just more people that overwhelm the amount of homes for sale. So that's why that market's hot. And any states like Florida, like Nevada, where you see a tax haven potential, those states are doing very well. So for investments, those are the highest demand right now. Florida's on fire because of the no state income tax. And then I see 9.6% of U.S.
Real quick, Barry, on that note, I had a message, it's relative, but I had a direct message there asking Bill, what is the situation with iBuyers in this space right now?
So, iBuyers are going to be part of what we deal with. iBuyers got left in the lurch when we headed into COVID and all those contracts were canceled. So iBuyer beware to know that that's a fickle environment for them. But iBuyers, listen, there's a whole thing. We could do just a talk on the iBuyer platform. The more you learn about it and the more educated people become, the more they understand that it is so deadly to a seller. Because the first thing they do is they don't give you a fair comp. They take the lowest amounts. Then they add in what they anticipate negotiated repairs would be. So sometimes that's not, especially in a hot market, you shouldn't have that. So what we did in our analysis, we discovered that people more often than not are losing, more often than not, at least 20% of the value that they could have if they went to a standard real estate agent. And remember that they do charge, typically speaking, 7.5%, which a typical real estate commission is 5 in California. And in many cases, you can negotiate that less because it's a hot environment. So the iBuyer platform, which will be there, which is easy, you get the implied guarantee. But if those sellers would simply wake up and say, geez, if I just try and put my house on the market, it'll probably sell. If it's priced right and it's priced accurately, it'll probably sell in 10 days. But you don't need the iBuyer platform. So it's a great question.
Yeah,
now,
and Barry, what I would piggyback with you on that is, so Wedgwood spent 4 decades at the auctions, and everyone knows most of those auctions have been shut down. And leading into the pandemic, they were actually one of the biggest buyers from one of the biggest iBuyers in the space. As all of you know, the iBuy play is really a tech play. There's not a lot of real estate experts inside those walls. They raised a bunch of capital. The model says we get a bunch of inbound interest. In the largest case, it's like 35,000 hits a month. They'll trade on about 1,000. And their buy box is actually really, really small. It's between this loan amount, not to exceed 500,000. It's paint and carpet, so no high cap X. And to Barry's point, in many of those cases, they do what's called walks. So they get them in the door, they do a little bit of research and realize that it's not what they thought, and they walk from that transaction, leaving that potential seller back where they started, emotionally a little disheveled. So I'm in alignment with you. I actually don't see a long-term play as the highest and best use for a seller unless they just have to transact super, super quick, and price isn't of the essence.
Thanks, Bill. Thanks, Bill. And you're correct. So I'm just going to go right down these questions here to try and attack all of them. So Eric brings up a great question. 9.6% of mortgages are in deferral. I think if you're talking about something called forbearance, it's actually down to 7.4% now. So it's actually been improving. And back in April, even though that you had people in forbearance, 46% of people were paying their mortgage on time. It dropped a little bit in May, where you had in May, there was actually 22%. Even if they were in forbearance, they were making their monthly payments. Now, in June, it dropped to only 15% of them. So that's mitigated to some extent. So really, it's perhaps closer to somewhere around 6.5% of mortgages. Still a very big number there. Now you say, lenders are not able to foreclose in many markets. Is this a bubble that can pop in the next year and will bring additional supply? So here's the thing. I really don't believe so, because when you take a look at the housing stock that's in the United States, so it's 127 million homes in the United States, 41 million are rented, the rest are owned. Of those homes that are owned, 34% of them are owned free and clear. Now you have about 53 million homes that have a mortgage, but the average loan to value is 53%. So the average amount of equity that people have in their homes is $177,000. Based upon that, there's a lot of equity that people have, and quite frankly, a lot of people took the forbearance route just because they were advised to do so because they thought it was a free ride. Now, the lenders can't really demand payment. And this is a misconception that many people have, and the media's got it wrong. So after the forbearance period, which can maximize at 12 months, then you can't demand the payment for those previous 12 months. What has to happen is now that amount of forbearance either has to be modified into the loan or put in what's called a secretary's lien, which acts as a second mortgage that rides alongside your first mortgage, and it gets paid when that mortgage gets either refinanced or the home gets sold, or maybe sometime in the future when the loan eventually does get paid off, which could be way in the future. So I don't believe that this poses a foreclosure risk, but what could be detrimental is if we go through this COVID period, and indeed, forget about what Russia says with the vaccine, but if we get, and by the way, another thing the media doesn't tell you, if you look at the recent statistics, deaths way, 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 way down. Look, 1 is too many, but they're way down, and new cases are way down. What the media says is, oh, all-time high in cases reported. Well, the next one that gets reported is an all-time high, right? I mean, we started at 0, so every single one is an all-time high. So we have to be careful with what we hear in the media. Cases are indeed going down. And I know that in certain areas, maybe they're spiking, but overall in the United States are going down. Deaths are way down in every single age cohort. I do a lot of information on this with the head of the Cleveland Clinic, Mike Roizen. He's a dear friend. He's Dr. Oz's partner. So I get a lot of data from him every single day. And it's starting to look better. But if we get a really good therapeutic or we get a vaccine and we get through this where it's a one-year blip, we're going to be great. If it's protracted and we don't have any good tools, it can be more problematic. Now, how can the middle class best position themselves to come out on the winning side of everything going on? So listen, here's one thing that we do need to be careful of. The stock market is a great area to create wealth, and what we look at here is we say, okay, what the Fed's tried to do is the Fed's tried to bring interest rates down to 0. This is from Ben Bernanke, right? And Janet Yellen, and now Jerome Powell. Why? Because T-I-N-A, there is no alternative. And the thought process is let's force people into the stock market, and that would create the wealth effect and people would spend. And to some extent, look, they've been successful, but it is a very dangerous game. Here's what we know about history. In the entire history of the United States, anytime that the price to earnings ratios get above 20, which is where they are now, and probably even higher than that, the following 10 years returns on the stock market are compromised. So if I were the middle class, what would I be looking at? I'd be looking at real estate. I'd be looking at gold. I'm going to say it. I've been saying it, Bitcoin. Why? Because when central banks put themselves in this type of a position, and when you have this type of pressure on currency, you do have those hard assets. Silver is a great one too. So those would be my personal choices of where I am personally. I can't give anybody advice, but if I were to just take a guess and say what I think that people should have exposure to that. Could you comment on the competing influences on mortgage rates, employment, economic activity, and the perception of risk? I think that we kind of talked about that a lot. So therefore, I feel that we've kind of covered some of that. Somebody says, do you see recession coming? Well, I predicted a 2020 recession. We got there as of February 9th, pre-COVID. We were right on. A lot of people didn't believe in that. We're in a recession right now that we will look back and say, okay, we came out of it because Q3 will be up, but up from very, very low levels. Down 34% on GDP off of 5% down in the first quarter. 2 negative quarters of GDP growth is the definition of a recession. So yes, we're in it. We'll see us coming out of it. It'll be a little bit on the slower side to come out of it. And much of it depends on how quickly we get the end of the sphere of COVID to see it really come back. Philip, that was from David. Philip Baroda says, hi, this is Philip with Coldwell Banker in LA. I agree with everything you're saying. However, I feel the real estate market is great, but prices have to be on target. By the way, Philip, you're 100% right. They do have to be on target. Overpriced listings in any market do not sell, and they do sit. Completely agree with you, Philip. You're 100% right there. My team is extremely active, and I've been selling for over 38 years. I started at 17. Good for you. And in San Fernando Valley, every listing is selling in multiple offers. You're correct on everything. I'm very impressed. That's really kind of you, first of all, Philip. So yeah, according to Redfin, they came out with the story 3 days ago, and they said that 56% of contracts or homes have competing offers. So many of them coming in over asking price. Today, it's not like buying a home. You have to win the home. So we try and do, and Bill knows, Bill has access to this stuff, is we try and come up with a way for individuals who can take a look at, if I'm coming in over asking price, how long will it take from both based on the current asking price and also based on an AVM automated valuation model for you to make up that difference in future appreciation. And most of the time it happens within 6 or 8 months, which is a small price to pay to get the home that you want. So in many cases, yeah, people do still have to pony up a little bit. Andrew says we've stepped up the entry level first-time home buyer and stepped up buyers pretty well. What do you see this low money cost environment doing to the luxury market? Well, the luxury market tends to sometimes behave on its own. It's been resilient in certain cases, but then when you take a look at areas like New York City, the luxury home market is getting crushed. We're seeing 50% drops in asking price in the New York luxury market. So I think that in some cases it's resilient. In this particular market, I think it is a little bit more vulnerable in the luxury environment if you are in a very high cost area, which many luxury home markets are. Now you take that and you go to the Hamptons, which is also a luxury marketplace, that is performing better. You go to Palm Beach, where I'm fortunate enough that I have some experience there. I have a residence in Palm Beach. That's doing very well, but that's attracting a lot of buyers because of some tax benefits that you do get there. Hamptons does not have tax benefit, but that is getting that insulated buyer. They're so darn wealthy, it doesn't matter to them. Let's take a quick look at this one here. Since there's a cutback, this is from Zhao, since there's a cutback in the number of new immigrants, buyers with cash coming into Southern California, would this particular group have an impact on the marketplace? Also, do you think the Exurbs area in the greater LA area will see a rise in home prices? Okay, let's go back to last part of the first. Absolutely, Exurbs will definitely see an impact. Now, you've already seen this with Chinese buyers. This all stems back to the fact that 15% of home purchases, believe it or not, in Southern California have been from Chinese buyers. And so they have a very important influence on the market in Southern California in the past. However, if you recall, all of this debate over tariffs with China, the US imposed tariffs with China, and what did China do to retaliate? They devalued their currency, their renminbi, by an equivalent amount. So by doing so, what they did is they negated or neutralized the effect of the tariffs. However, what they did was they made real estate for those Chinese buyers more expensive because it takes more renminbi that you have to bring from China to the US to buy, and it makes a home that was $1 million now cost $1.1 million. And that's one of the reasons why you've seen a little bit less influence of Chinese buyers in Southern California. So I agree with you completely, and I do think that it does have an impact, although the Exurbs should be very, very good. Kenneth, all excellent, accurate information. Thank you, Kenneth. That's very, very kind of you. Very good touch on conventional side of things. But what do you see for investors, wholesalers, and fixed flippers in relation to this new market? So listen, I love fixing up homes. I used to do it when I was younger and had the energy for it. But I think that this is a brilliant way to do it, especially if you've got, look, somebody like yourself who's talking about this, you probably have some experience and you could find some areas where you know what you can fix up and you can get results on. The bulk of us who buy a home, we don't want to fix it up. We just want a place we can move into. So somebody who can make that arbitrage and purchase a home, that's a really, really smart way for you to make money. So I compliment you and commend you. And also, Keith, thank you for the kind words. Eric, there are a lot of dollars outside the US. Do you see dollars coming into the country over the coming years? More inflation. The reason why I don't is because, first of all, coming years, it's relative. So if you said the next year or two, it's easier to forecast. Down the road, we don't really know. But what we're doing by keeping our interest rates low is we're essentially a race to the bottom to try to devalue the dollar. And if you look at the dollar index versus other currencies, we've done that. By our dollar being less in value, what it does do is it gives people from abroad a little more buying power initially. But if they're concerned that the dollar trend will continue lower, they will be less inclined to purchase assets here in the US, because while they might make money on their asset, when they go to repatriate it back, they could actually lose on the transaction because of the currency exchange. Currencies are always a little bit difficult to say. They're hard to predict, and the outcomes of it really depend on the time horizon of the investor. So guys, all great questions that you brought up. So thank you for that. I think we went through all of them.
I have another one, Barry. Thank you so much. I have another one that came through is in regards specifically to hard money lenders. How have hard money lenders weathered the COVID crush, and has the markets come out on the other end?
So Gina, I will admittedly, I'm going to defer to Bill. I don't have that deep of an expertise on the hard money side. We know that, you know, one of the hallmarks of hard money is you're basically lending on the asset itself as your collateral. And I can tell you that from the support of that collateral, I do believe that home values are, as we discussed earlier, going to be supportive and should rise. So that's a good thing. But Bill is probably a lot smarter than I am in being able to answer this question.
Yeah, Gina, here's what I would say just holistically. It's gone through a phase, right? So when the pandemic hit, I think it wiped out 75 to 80% of what I would call more of the institutional private money lenders. And when I say wiped out, maybe put on pause, maybe close down shop, but they had to settle a bunch of back end financial issues related to margin calls and the repricing of what those assets were. What I would tell you is when that happened, a lot of the hard money or family money lenders came back into the space because rates jumped up about 200 basis points in a very short period of time. And so it gave them a lifeline or life in the market. Since that time, we've seen a whole bunch of those people that were on the sidelines and go pause, settle their accounts and reconfirm new warehouse agreements and outlets, and you've seen them back in the space. I don't think the space has fully recovered as a whole. Rates are still 50 to 75 basis points higher than they were at the time the pandemic started. Leverages are still about 5% across the board, lower than when they started. And there are some parameters and guidelines in and around that space that didn't exist before. But you know, my Barry crystal ball tells me before the end of this year, I think all of that is back in the space, and I actually think it begins to thrive again.
And as we're kind of winding down on the hour here, question for both of you is, as we head towards the end of 2020 into 2021, what should loan officers be focused on?
So first of all, don't even talk about the end of 2020, okay? Because it's August. No, Jeannie, you're right.
Before we know it.
Jeannie, you're right. It is here before we know it. So if I were a loan officer today, you got a lot of free money in refinances, but don't be transactional. You have a chance to change people's lives every single day. So look, most people, you know, it's easy. They'll do a loan. They'll save $270 a month. That's $9 a day. They're going to take that money. They're going to blow it. What you really should be focused on is how can they use that money to change their life. You know, if they're 40 years old, they're going to retire at 67. You can take that same amount of money and turn it into a $50,000 a year annuity income without ever touching the asset that they could leave to their heirs when they do retire. And that's what changes people's lives. Or you could do a debt consolidation where you can now incorporate people's debts, pay them off, and take the savings, accelerate the mortgage, and now wind up giving them 12, 13 years shorter term on their mortgage, the best retirement plan in the world, and accumulating enough of an equity position to pay for their kids' college or really ensure their retirement where people are not in a position to do so. So I'd be thinking like an advisor, number one. And number two, don't take your eye off the purchase ball just because you have so many transactions that you can do from the refinance standpoint. You got to elevate your game, do it great. If you're a loan officer, this is not the time to take up golf. This is the time to really raise your game and do everything well and to really educate yourself, because here, you know, never do one transaction at a time. You should always do two, meaning the transaction today and how does it fit with the next transaction? How do you take care of your customers' needs into the future and set them up? So this is what you should be doing, and look at your purchase transactions today in ways that really can help people get in that home, because people who purchase a home today, it takes a little extra work, will really reap the benefits, because the average person stays in a home for 10 years. And I will give you my really, really easiest forecast is that home values will be a lot more expensive 10 years from now than they will be today. So the idea is get into the game.
Yeah, I think what I would add to that, Gina, is advice my father gave me in 1985 when I got into this space. He says, Bill, you sleep when you're dead. And the opportunities right now are so great that the whole golf comment Barry said, I think it applies to everything. Most of my calls on the conventional side tell me just how swamped and drinking out of the fire hose. And I always say the same thing, it beats the alternative. Rates will go up someday, and you're going to be fighting in the streets for that next refi. So off the heels of Barry's comment of keeping your purchase relationship strong and not turning your backs on that because you get to do the Smith loan 4 times in a year, I think is important. But I think this is the time to grind. If you're a conventional lender, these are the best of times that Barry or I or any other person that has any market reference has ever seen, and take advantage of them. They're not going to be here forever. And so great insight, Bear. And you know, I was sitting here thinking, and I'm supposed to be interviewing you, and I ended up taking 3 pages of notes just on different aspects of points you covered, because it's just so incredibly insightful. And throughout this time, my phone's been blowing up with people who haven't been exposed to you. Who is this guy and where did he come from? And it's, I think everyone benefited tremendously from the last 57 minutes. And
you know what, Bill, first of all, thanks for your kindness. There's a couple of more questions. I want to try and get to them to be respectful to the people who just answered them. So David asked the question, what do you see happening with jumbo products? They come back slowly. As unemployment starts to become less of a concern, and it will over time, jumbo will really come back in earnest, because you got greed and fear, right? So a little more fear, a little less greed. As fear subsides, that greed is going to come in there. So it's going to come back. So just be a little bit patient with that. And by the way, Scott Houlihan, my dear friend, love you, brother, and thank you for your kind words. And then Greg Franklin says, appreciate your expertise. Greg, thank you, Greg. As baby boomers and their parents age, what do you see as motivating factors for empty nesters to move? Greg, what a great question. Because as people have been getting older, you know, the next step you know, it's a sad thing to say, but the next step is that sometimes you get these assisted living homes and you go to, you know, places like that. But with COVID, people are doing so much less of that today that you're not getting that inventory on the market. So thank you, Greg, for bringing up this point. I'm ashamed that I forgot to mention it because it's so important. You'd normally be getting all this inventory that would be coming on the market as boomers start to age even further. And now they're ready to, hey, look, I'm going to hang it up here. But they're holding on to their homes because the last thing they want to do is move into a facility where they are going to be more at a health risk and nobody wants to visit them. So people are not putting homes on inventory. That's exacerbating the problem, and it's greater support for the real estate market. So thank you for bringing that up, Greg, and thank you for your kind words, David, as well.
Gina, anything else?
No.
Barry,
We have covered all of our questions.
humongous thank you from all of us at Civic.
Thank you.
Thank you. Did a great job narrating. If you haven't, I think it's coming out when, Barry? Your book, October 27th?
October 27th, you could pre-order it. I'll tell you what, team, it is, I know it's my book, and of course I'm going to say, but you know what? It's a great book. It's a very inspirational book. If you're going through a tough time, it'll help you. And if you're going through a great time, it'll help maximize it. But I think what the key to the book is that there are opportunities everywhere. And one of the things that is a real skill is how do you see these opportunities? And I truly believe that this book will help you. And it's a lot of fun. It's entertaining too. It's gotten some incredible reviews from, you know, Tony Robbins and the Zuckerbergs. And so I think you'll enjoy it. It's well worth it. And if you guys decide to pick it up, I'd be honored.
Our company is pre-purchasing 300 for all of our agents at Civic and our operations staff. So I would also recommend the book for any of you that called in.
You can pre-order it on Amazon, correct, Barry?
Yes, Money in the Streets.
Okay.
Barry, thank you so very much. Very, very much. And thank all of you who took the time to call in. Your time's money, and we appreciate you spending that with us.
Bill, it's a privilege to be with you and Liz and Gina and with all these wonderful folks that have been so kind and all these kind comments. It means the world to me. So God bless you all, and thank you so much.